Welcome to the Decision Makers. Hi, I'm Jerry Sont. Today we look at cash as an investment choice and the considerations it raises for banks and advisors and other people working in the wealth management industry. We'll tackle some of the common issues and concerns surrounding cash and provide some in-depth insights into client requirements and some solutions to meet those needs. In this program, Decision Makers will share their thoughts with you. I'm speaking now with Brendan Gleeson, Financial Advisor, Wilson HTM Investment Group. Brendan, welcome to the Decision Makers.
Thank you.
Brendan, why is cash an important asset class for you as a financial advisor?
I think the importance of it very much depends on the type of investor you're actually dealing with. In a general sense, cash is important as a short-term investment to provide a rate of return on funds, but also it has a very good place in diversified portfolios to help smooth out volatility and smooth out your returns. But like I said, depending on the type of investor that you're dealing with, it can have a much higher degree of importance, and probably the easiest example is with a retiree. They use it for simplicity and transparency as well as a liquidity buffer in their accounts, and probably the best example I could offer is during the downturn when people are relying on their assets to fund their retirement needs. The worst possible situation you could have been in was to be relying on those assets and selling down on your share investments at the lowest possible price during the downturn. For those people who did have the right cash strategy and cash investment in place, who were able to rely on the cash and allow the asset values to come back up with the market, that was an extremely strong strategy for them and was actually able to preserve wealth in the long term very significantly. As well as that, I would say there's other uses for it as well. If someone is potentially with a longer time horizon and they are looking at focusing on performance and returns a little bit more actively, someone who may be using a tactical asset allocation strategy, it can sometimes be used as a very good short to the market if they do expect that the returns in the market are not going to be that great in the short or medium term. Cash can be a great place to park your money and generate a rate of return while you wait for the right opportunity to get back in. So, like I said, depending on the situation of the client, it can have a varying degree of importance. However, overall, it's definitely an asset class that we do think is extremely important and we will always look into. So,
what are the challenges that you face in the wealth management industry in regards to what customers are looking for in investments?
I think the challenge is always going to be to find the right combination between performance and service. Performance, we've found, is very much a relative thing in the sense that you can have a client which is doing rather poorly, but if the market is doing very poorly, they can accept that to an extent. However, if you look at a client who's invested in a particular product or idea and their next door neighbours in a similar offering and they're getting a much better rate of return, well then it's going to be hard to justify your value to the client. So the performance is always going to have its aspect to it, and I think as well as that, the service side of things in terms of how it's administered and how it's reported, you can be getting very good returns, but if you're creating a headache for the client and it's very difficult for them to go through the process, they will then question again what value or the ease at which they're able to accomplish those returns. So I think it's definitely finding the right combination of those two to deliver to the client as a total service offering.
How has St. George partnered with you to satisfy your cash investment needs as a financial planning firm?
At Wilson HTM, we very much focus on active management, where we deal in the direct equity space, directly, as well as using managed funds as an investment vehicle. So, because we are so active in that manner, we do find there are large sweeps and volumes of money going into and out of cash and through settlements and similar things like that. We found that in our experience, it was difficult for us to find the right combination of the so-called bells and whistles on accounts that a lot of other advisors potentially didn't need, but we did in terms of reporting and administration and facilitating. And we generally found that the people who were able to provide that did actually have to make a sacrifice on performance. And we found that St. George was one which actually came to us with probably the best combination of performance and service in that manner. So it's something which has worked very well for us, and it's been a good experience so far.
What are the important features that you've found help you, your business and your clients with the St. George CMA?
I think just ease of use, speed and accuracy of reporting are very big things for us. The ability that it was able to be, I suppose, submerged into our existing infrastructure was very good for us as well. It was very seamless in that regard. Also having a large institution behind it, the service side of things, people generally find a lot more confidence in that. I think it's something which cash is not very an area which you would be investing in for any kind of risk, so that's always a benefit. And I think that we've generally found that a lot of prospective clients do have existing St. George accounts, so we've actually been able to just wrap our services around that. So it's probably helped reduce procurement time and I suppose ease of transition for clients to come on board. So for us, that combination has been very good.
How do you see the needs of the financial planning industry for 2011 and 2012 on the back of the GFC?
I think we probably saw a period where regulation and legislation was a little bit on the lax side before the GFC, and some clients definitely suffered because of that. And now we're going through a period where we're seeing increased regulation and legislation come back on board, which is natural after we go through such a period as we have. So I think that it's going to create a bigger or more intense focus on the value you create for clients, transparency, value of advice, questioning fees. These are all things which I think are going to be more intensely focused on moving forward. That being said, I think that any particular product or advice or structure or arrangement you can have, whether it be through your advice or through your product providers, which is going to help you be more efficient and add more value to clients in their eyes, it's going to be extremely valuable going forward, because you're definitely going to be asked to prove your worth, I think, on an ongoing basis.
Brendan, as a decision maker, thank you for your insights today.
You're welcome.